I've been privileged to observe at first hand the impact of technology in finance. When I began my career, fax machines and electronic typewriters were the order of the day. Portable computers weighed 20 pounds and were called luggables. And mobile phones were the size of bricks. Email arrived in the late 80s. It was provided to senior executives, who of course had their PAs print out their emails so the boss could handwrite a response, which was then typed into email again by the long-suffering PA. I showed this speech to my daughter when I was right here. She's 26 years old. She said, "Dad, at this point you'll have completely lost the younger audience. So if you're below 40, I apologize." And I remember in the mid-90s building a business for corporate customers to electronically display certain documents. And the business case hinged on whether we could afford 2 T1 lines. Now, T1 lines are data lines that carry voice and data across them. And today, those T1 lines would cost you about $200 to $1,200 a month to rent. We needed 2 of them. And in those days, they were so expensive that we almost didn't enter the business because of it. And I've also experienced how new technologies have started to make consumers' lives easier. I remember how in the mid-2000s, contactless payments became introduced into this country, so now you can use your contactless cards on the tube, as Simon was saying, and Simon, just so you know, I did that myself today. So, and when I was at Barclays, we launched Pingit, Europe's first person-to-person payment system based around a mobile phone. Now, all these experiences have made me a passionate believer in the transformative power of technology. It's an unstoppable force which often has a hugely positive impact on the way we live, the way we work, the way we consume, and the way we learn. Many wonder how these new technologies will transform the financial services industry, a sector which is already being reshaped by current and prospective macroeconomic weakness, as well as regulatory change. You might well ask, who will the winners and losers be? It's an important question. An effective, fair, and transparent financial services sector is vital for economic growth and also for a functioning and healthy society. And that's especially true as the industry itself has not always delivered its side of the bargain. I'm predicting that over the next 10 years, we will see a number of very significant disruptions in financial services. Let's call them Uber moments, driven by companies in the so-called Fintech sector, the world where financial services and new technologies link together. We will see massive pressure on incumbent banks, which will struggle to implement new technologies at the same pace as their new rivals. And that will make it increasingly challenging for them to deliver the returns and profitability that their shareholders demand. Ultimately, those forces will compel large banks to significantly automate their businesses. I predict that the number of branches and people employed in the financial services sector, as we view it today, may decline by as much as 50% over the next 10 years. And even in a less harsh scenario, I expect a decline of at least 20%. So what exactly is an Uber moment? I know that most of you will be familiar with Uber. Did anybody come here by Uber today? Anybody? Yes? One very sophisticated gentleman on the front row. Uber's typical of what I saw when I recently spent a week in Silicon Valley meeting venture capitalists, technology companies, entrepreneurs in the fintech sector. If you analyze how technology has already disrupted many industries, ranging from publishing, telecoms, and music, to retail and even transport, you can detect a similar pattern. It starts with a small group of founders using new technologies such as mobile phones and fast data networks to dramatically improve or disrupt a so-called vertical, a market that's focused on a single niche. In Uber's case, it was as simple as providing a car and driver in San Francisco, available via touch on your smartphone. And once a company dominates a vertical, the service gets rolled out across the globe to the point where many of us have the Uber app installed on our mobiles today. This demonstrates how the digital revolution is making many aspects of our lives easier. And services that used to be out of reach for many can now be made available to nearly all globally. In other sectors, we've seen how fast-growing companies with an entrepreneurial mindset have led to the demise of once powerful brands, such as Nokia or Kodak. Now, thinking about an Uber moment in financial services, we can see from the example that I've given what such a moment would look like. Firstly, and most importantly, it must be disruptive. That's to say, it needs to dramatically improve the customer experience. Some people would say that this has to be at least 10 times better. Or it can create a whole new customer experience that didn't even exist before, as in the case of Facebook. Secondly, technology must power the service and be at its core. Thirdly, there must be a ubiquity to it. Uber is now in 300 cities in 58 countries. And finally, while there may be others doing the same thing, there is usually a dominant market leader. Of course, much of this activity is based in Silicon Valley. The moment you arrive in Silicon Valley, it's impossible not to feel the incredible energy and be impressed by the vibrant and mutually supporting ecosystem of investors, venture capital, founders, and academia. In every coffee shop or restaurant, it seems, there are 20-something founders talking to 30-something investors about seed funding. But while it appears to be casual and laid back, it is at the same time a ruthless meritocracy where the best ideas win. It's really a unique place. And there's a massive wave of capital going into startups. One of the people I met even expressed a view that there's maybe too much money around, and at the moment, poor ideas are being supported as well as the good ones. The efficiency and ruthlessness of Silicon Valley is mirrored in a clear startup model. It goes like this. Pick your niche, figure out how to transform it through technology, prototype it, scale it, make it profitable, finally IPO it. In Silicon Valley, I got a real sense of how the next wave of transformation is targeted at more complex markets, such as financial services, healthcare, and education. In the finance industry, we already have seen the emergence of peer-to-peer lending sites such as Lending Club, Prosper, and RateSetter that allow individuals or institutions to lend directly to others without involving a bank. And exchange platforms such as Cantox allow customers to trade foreign exchange directly. Startups such as TransferWise charge less than some traditional banks to send money across borders. In the payment sector, the activities of many startups are still extensions of the existing banking system, such as Square, an application that allows small merchants to plug credit card readers into a smartphone. The wealth management industry is another sector waiting to be transformed, with a whole range of startups such as Nutmeg and Wealthfront using algorithms to help you manage your money. However, I view much of the activity as version 1.0 of the fintech revolution. Some would even argue there's really not that much tech so far in many fintech companies. For example, some of the lenders in the US make extensive use of that 20th century marketing channel, direct mail. Most payment activity rides on top of the traditional banking system, and no one has yet cracked the code in wealth management. Most startups so far struggle with the challenge of winning customers in a cost-effective way and scaling their business to the next level. And the same is also true on this side of the Atlantic. While there is a burgeoning startup scene in the UK, we're still waiting for really transformative projects, the ideas that will revolutionize financial services. But with the tsunami of capital working in the sector, we cannot be far away from truly disruptive breakthroughs from versions 2.0 and 3.0 of the fintech revolution. You can already see the big digital drivers that will disrupt the finance sector. In future, new companies will deliver financial services at a fraction of the cost. Truly digital banks will be able to spend most of their resources on the development and deployment of technologies and won't need to sustain a network of physical branches and offices. The deluge of data available in today's world will lead to much more personalized financial products and services. Just imagine for a moment how much information is hidden in a bank statement. The data about how much we spend each month on groceries, rent, school fees, or mortgage payments reveals a lot about how we live our lives. Smart digital companies will use this data to advise us on the best mortgage deals or wealth management services tailored to our individual needs, and then allow us to manage our finances with easy-to-use apps on phones and tablets. Also, the long-term demographic changes means huge parts of the world are becoming more affluent. Just look to Africa, where new services allow consumers and businesses to use mobile phones to pay bills, make purchases, or manage savings. Relatively few consumers in those markets have traditional bank accounts, while most now own a mobile phone. Of course, we need the right regulatory framework to make sure that our data is used with permission. And also, cybersecurity will become an even bigger issue and a key element to win customers' trust. The coverage of the TalkTalk hack in October has shown how the public can get rightly and highly concerned by hacking scares that talk of bank accounts being emptied by electronic thieves. But the overwhelming majority will embrace these new services where there are significant and compelling benefits over the status quo. But these services cannot only be incrementally better, they need to be at least 10 times better. This is exactly what we've seen with other digital services, be it Facebook, WhatsApp, Twitter, Uber, or services that allow us to store our family photographs in the cloud. Financial services companies face the same challenges as their counterparts in other industries. Earlier this year, I visited a large retailer in North America, and in a meeting with the CEO, it became crystal clear how difficult it is to come up with the right strategy in this new age. For example, would you make an acquisition of bricks and mortar stores when the rise in online orders could slash the value of those assets? Or should you abandon your traditional business, even if it's profitable, to focus on the digital side? Now, you might actually believe that many in the banking sector have fully embraced new technologies and are well prepared. You just need to read some of the headlines from the financial press recently. Banks desert high street for the digital superhighway. European banks use online platforms to find borrowers. Banks to allow account access using fingerprint tech. But the impression we get from these headlines is misleading. Despite the appearance of change, the incumbents will need to undergo the transformation seen in many other parts of the economy. According to McKinsey, the digital revolution is set to wipe out almost 2/3 of earnings on some financial products. For example, the consultancy estimates that profits from retail lending, including offerings such as car loans and credit cards, could shrink by as much as 60% over the next 10 years. And the boom in online banking is already forcing banks to change the way they conduct business. Last year, US banks closed a record number of branches. And in the UK, the use of bank branches fell by 6%. As a result, the financial services sector will employ fewer people. Some of Europe's biggest banks, including Standard Chartered, Deutsche, and Credit Suisse, have in recent weeks unveiled plans to cut more than 30,000 jobs, partly because stricter capital rules are eroding profitability. And the forces of the digital revolution will put even more pressure on banks to slash costs. The unique set of skills needed to succeed in the digital world represents a huge set of challenges for the incumbents. Many have been touring Silicon Valley looking for inspiration for their management teams, but all seem to struggle with the different culture and skill sets that are needed to be successful in the new digital world. There is obviously already a lot of technology used in financial services today, much more than it used to be. I remember filing paper statements in the South Kensington branch of Barclays, my first job. If you walk into that branch in London today, you'll see a plethora of technology, from ATMs and cash and deposit machines to iPads for digital banking. But incumbents must ask themselves, how much of this has been truly disruptive or transformational, as opposed to merely substituting capital for labor? Just take ATMs or cash machines. While they make our lives much easier and have allowed us to get cash out abroad from a domestic bank account, a brilliant innovation, they didn't transform the existing system and the hierarchy of the banking world. They only made it easier to use. And call centers and internet banking may have helped to improve customer service, but they're only used on average about twice a month. They're not transformative services. On the other hand, customers use mobile banking applications up to 30 times a month, indicating how smartphones have the potential to clearly transform the customer experience. But we have to keep in mind, of course, that not all technologies are a force for good. In the institutional banking sector, new technologies facilitated the creation of complex derivatives that contributed to the financial crisis of 2008. That was clearly disruptive, but not in a good way. While it's clear that incumbent banks are vulnerable to the disruptors, we should not ignore the fact that the incumbents have some real advantages. They have well-known, powerful brands that many customers trust, a large number of customers, and a wealth of marketing experience. They understand and can navigate the regulatory landscapes and have enormous financial resources to take on the new rivals. Now, you may have noticed that my time as CEO of Barclays recently came to an end. I'm very proud of what we achieved. My team and I always saw digital innovation as a way to improve service for our customers. And it helped us to simultaneously reduce cost, improve control, and enhance the customer experience. I'm passionate about technology to the point where I often tested the patience of my colleagues around the user experience, what's called in Silicon Valley UX, down to how many digits we should have in the logon code, for example. I argued that 4 was better than 5, a battle I ultimately lost. I realized that financial services needed to embrace new technologies, not reject them. During my time at Barclays, we mentored new fintech companies through our accelerator program, and we introduced the digital driver's license, a free service where people could teach themselves new skills. Other initiatives included Code Playground, a program that helps children learn coding, and our Digital Eagles, 28,000 specially trained colleagues who advise customers on technology. My aim was to make Barclays the most technologically savvy and automated bank in the world. But this was never about replacing colleagues with robots. My goal has always been to deploy technology effectively to free up people to do what they do best. Now, in doing this work and engaging with other CEOs around the world, it became clear to me that incumbents will have to address 3 significant issues. First, boards need to accept that we live in a discontinuous world where they should ask executives to take significant but calculated risks by working on initiatives that no one else is working on. Looking for a simple linear progression just won't cut it today. Secondarily, there shouldn't be a technology strategy. There should only be a strategy with technology at its core. There's a crucial difference. And thirdly, executives need to lead differently. In my experience, leaders become more risk-averse the more senior they become. In fact, doing the same old a bit better is infinitely more risky than being bold and seeking true transformation. But this leadership in the digital age needs to be based on values. The current controversy about Uber and the way it disrupts the taxi market across the world highlights that values need to be at the heart of the debate. In the 80s and 90s, the emphasis of the business community shifted to create as much shareholder value as possible. Long-standing business practices that prioritized customers and colleagues and had a positive impact on local communities and societies were suddenly cast aside. But the key lesson from the financial crisis of 2008 is that business and finance need to be based on values that balance the long and the short term. Banks were too aggressive, too self-serving, and too focused on the short term. The impact of these mistakes is still being felt, and we have seen public trust in the industry sink to an all-time low. But this is as much a commercial imperative as a moral one. For in my experience, the branches, for example, that have the highest levels of customer satisfaction had the highest levels of colleague engagement and were also the most profitable. My absolute conviction is there can be no choice between doing well financially and behaving responsibly in business. In Silicon Valley, I was struck by a similar ethos of innovation and business creation. They're driven by building the best possible products to help customers improve their lives. It may surprise you to know that no one I talked to in Silicon Valley woke up in the morning wanting to be the next billionaire, but they all wanted to change the world. That's the language they use. We want to change the world. And many of the fast-growing technology companies have a sense of citizenship. They see wealth creation as a byproduct, not as an end in itself. We have a great opportunity to build a more sustainable and just finance industry that will enable consumers and businesses to experience banking in a radically new and better way. Considering the whole range of powerful forces that already support and feed each other, I have no doubt that the financial industry will face a series of Uber moments. Firstly, the global financial services market is huge and provides large profits. That guarantees that many smart people and lots of capital will try to disrupt and transform it. This huge influx of capital might create some short-term bubbles, but it won't change the final outcome. Secondly, the cost of new technologies will continue to decline. And new cloud and storage systems will make it even easier for new players to enter the financial services market and then aggressively scale their business. Thirdly, there's a tremendous amount of work being done in the artificial intelligence space. These software applications allow robots, computers, and smartphones to recognize patterns and learn on their own, allowing them to make increasingly better predictions about our behaviors and financial needs. There are already virtual assistants such as Apple's Siri and Google Now, but the future will bring us much more intelligent applications that will use natural language to interact with human beings. And this is going to have huge implications for the nature of work and of our lives. Fourthly, the incumbents are already under considerable pressure from a relatively weak macroeconomic environment and regulatory change causing poor returns on equity. Customer expectations and the need to respond to the disruptors will exacerbate this return problem. The incumbents risk ending up as mere capital-providing utilities that operate in a highly regulated, less profitable, and capital-intensive market segment, a situation unlikely to be tolerated by shareholders. However, in my view, only a few will have the courage and decisiveness to win in this new world. In conclusion, as I stated at the start of my speech, I predict that over the next 10 years, we will see a number of Uber moments driven by fintech companies. Initially, I expect the first Uber moments will be in payments and lending, two areas for many incumbents that are significant. For the traditional banks and service providers already under pressure from lower growth and regulation, profits and returns will be harder to come by. And inevitably, customers will demand more automated and cheaper products and services. Incumbents will struggle to respond, leading to a 20 to 50% reduction in branches and people employed in the traditional industry sector over the next decade. Ladies and gentlemen, the Uber moment in financial services approaches. Thank you.